Welcome to another edition of Market Minutes with M&K Legacy Wealth. We wanted to give everybody an idea of how we're feeling about the stock market, kind of what some of our thoughts are as we head into the second half of the year. Nothing that we talk about here is to be construed as advice, but if you do have any questions about any of this, don't hesitate to reach out. We'd be happy to discuss further with you. So with further ado, let's kind of jump into some of these thoughts. It is summertime. It's baseball season. I heard somebody say this recently. It was definitely piqued my interest a little bit, but that the famous hitter Ted Williams wrote a book called The Science of Hitting, I think back in the 50s, if I'm not mistaken. The person that referenced this said it was one of the greatest investment books of all time. Yeah, you heard me right, investment books. What they meant by that was in this book, Ted Williams has kind of some thoughts on how you basically look for insights into what might be coming next. And so he has some quotes in here, such as, "I've said that a good hitter can hit a pitch that is over the plate 3 times better than a great hitter with a questionable ball in a tough spot." He goes on to say, "Obviously, you don't just guess curve or guess fastball. You work from a frame of reference. You learn what you might expect in certain instances, and you guess from there." So what that means to us from an investing standpoint is that when certain things tend to happen in the market, they can give you some insight on what might come next. And so that's what we're often doing, is looking for kind of these tips and historical perspective to say, hey, based on what has happened recently, what might we expect next? So with that said, we had a crazy first half of the year, definitely one for the ages. When we think about what happened in the first part of the year, we really had kind of 2 events. We had a big fall in the market to start the year, and pretty much first quarter plus maybe a week or so into the second quarter, to where from February of 25 to early April, we saw the market fall 19%. Well, if we look at every instance that the market fell 19% or more, going back to 1950, so essentially the last 75 years or so, we kind of have them all stacked up here on the chart in order of when they happened, if you will, starting with 1957 there at the bottom. So this was about a 19% decline over 1.6 months, or just over a month and a half, we'll say. So it was a pretty fast decline. We often talk about there being some symmetry in the stock market when you see kind of a speed and magnitude of a sell-off is often matched with a similar speed and magnitude of a recovery. And so, which is exactly what we saw in this case, because from that bottom in early April, it only took us a little over 2.5 months, 2.6 on here, to get back to a new all-time high. If you looked at it from the all-time highs that we were hitting early in the year before the fall, down through the fall, back up to a new all-time high, we were looking at just a hair over 4 months is all it took to go from peak to peak, if you will. So when you look at those two kind of from a historical standpoint, that was an extremely fast peak to peak time period, as well as a really fast kind of low back to a high time period. So we definitely saw one heck of a rubber band, so to speak, kind of bounce back through the second quarter in the market. And so when we tend to see these really strong markets, what might we see next is what we're after here. And so if we're looking for that same historical perspective going back to 1950, we did have a 3-month period that just ended back in early July here, where the market was up 26%. That is a strong 3-month period. In fact, one of the 6 strongest, we could say, or one of 6 times that the market was up 25% or more over a 3-month period, going back to 1950. So what happened the other 5 times? In the other 5 instances, what we saw was that over the next 3, 6, and 12 months, the market continued going up. So who knows what this time will bring, but if we are looking for some historical context, when this kind of momentum comes into the market, it does tend to lead to further gains, historically speaking. And so on kind of from a median perspective, we saw the market rise 18.5% over the following 12 months. So this gives us, definitely some reasons to be optimistic. Is 6 instances, enough to go off? It's not a huge sample, so to speak, but we do often talk about momentum in the stock market and how momentum tends to lead to kind of more momentum in the same direction a lot of the time. And so, the market up in this next 12 months, averaging 18% on median, we'll say, versus all years since 1950, you saw the market go up about 10.5%. So definitely some strong potential ahead of us. The other thing that we're kind of talking about here is that the market's hitting new all-time highs again. And we hear this a lot from investors that we've all been taught buy low, sell high. So you've heard us talk about this before maybe, but in the end, buy low, sell high is maybe not always the best mindset when you're kind of thinking about momentum in the stock market overall, because what we tend to see is that when we hit new all-time highs, we often continue to see more and more all-time highs. And so every little plot that you kind of see marked here with the green diamonds are all-time highs that the market hit. So we're really looking since 1990 here on this particular chart. And you do see that once they start happening, they really cluster together as the market continues to rise. So over the last, 35 years, we will say, it has definitely been the case that if you said a market just hit a high, what did the next 12 months bring? You had an average return of 11.5%. or a median return of 13.5% over the next 12 months after the market hits a new all-time high. You have an 82% win rate. In other words, the market's higher 82% of the time. And if we kind of think back to that prior chart, the market on any average year is only up about 73% of the time. So it does seem to show that when the market's hitting new all-time highs, we do often end up seeing it be the case where kind of the party continues. Another way to kind of think about this, again, 1950 through the second quarter of this year, or the first half of the year, is 1 year after that all-time high. So when the market does hit a new all-time high, it's up on average, going back to 1950, 9.6%. If you just looked at any other year, just the average year in these 75 or so years, the market's up 9.3%. So really, you are, whether you're looking at a 1 year, 3 year, or 5 year period, you do see that the time periods following an all-time high outperform a typical average year, if you will. So kind of interesting, not something everybody would necessarily believe to be true based on buy low and sell high like we've been taught, our whole investing lives here. So the other thing as it relates to momentum that we wanted to point out here was on this chart, we're really showing 2 segments of the market. In the blue line, we're seeing what we would call the cyclical sectors. These would be sectors like technology, things like materials or industrials more so. Maybe you would think of consumer discretionary items, things that do tend to go more along with how the economy is going. In the orange line, you see what we would call the defensive sectors. These might be your consumer staples, healthcare, things of that nature. So when we kind of think through these 2 baskets, one typically being more volatile than the other, you can definitely see that since that market bottom, we have absolutely seen these cyclicals take all of the momentum in this market. And so we do see that the market is telling us that is more of a risk on time period right now. There is definitely a lot of momentum going towards kind of the internals of the stock market, kind of the inside of the stock market of the more cyclical natured type companies. And so Treasury Secretary Bessent has said in a recent interview, and I'll quote him here, "I will take the market-based indicators over these so-called experts all the time. That's how I made my 35-year career listening to the market." So in other words, we hear a lot of talk about what economists are saying out there on Wall Street, but sometimes it's almost better just to look at the inside of the stock market and say, what's the stock market telling us? And what it's telling us right now is that these cyclicals are definitely the place to be, if you will. And so to a lot of people, they've kind of wondered, how broad-based is this rally? So we've seen this big rise in the stock market from this bottom, and way over here to the right, we're looking at the S&P 500. What this really shows is in blue, the blue bars, the percentage of the S&P members, so those 500 stocks, if you will, that are trading above their 50-day moving average. That's kind of an average price over the last 50 trading days, if you will. In gold, it's the average price over the last 200 trading days, and what percentage of them are trading above the 200-day moving average. And so you currently have 77% of the S&P 500 trading above its 50-day moving average. So it's not just a handful of tech stocks kind of leading the way in this. In fact, you see the utility sector, which is something we might touch on a little bit later, moving higher in a major way. 97% of those companies are above their 50-day moving average, 94% over their 200-day moving average. But across the board, you really do see strength across many sectors. Some of the ones getting left out would be the ones that kind of lead that defensive sectors from the prior chart, and that would be your consumer staples, your REITs, when we kind of look at the 200-day moving average, at least, and healthcare, not quite participating in the same manner, if you will, but it definitely is a broad-based rally to this point. One thing that gets us a little optimistic as well is that we kind of look across the investing landscape and we still don't see a lot of bullishness out there. And so what this chart shows, we've showed a similar chart of this in the past, but it's basically looking at individual investors and saying what percentage of them are bullish minus what percentage of them are bearish. And so historically, when you get to these real negative numbers, just like we saw back in the spring, as you might recall from our last video, we got to this very oversold condition. It was like everybody got negative at once. Well, typically that's a pretty darn good buying opportunity. And so now we've definitely seen the individual investor bounce back in a pretty big way. Although lately, if we kind of just look in the last maybe week or two, we've definitely seen some of that enthusiasm wane, and we're kind of back to almost a neutral level, if you will. So we're very far from kind of peak euphoria, if you will, in the stock market where everybody's excited and optimistic. And so sometimes that's a good thing to us. And the reason we say that is it does lead to more money. We have more money on the sidelines willing to come back in, if you will. And so another way to look at this, that chart was the individuals. This one would be more your Wall Street professionals, so the large speculators and hedge funds. This is kind of something that's based on, are they betting on stocks or against stocks, if you will. And until recently here, we're still seeing the large speculators and the hedge funds be very negative on stocks. And so this big rally that we've had has really happened in many respects without the majority of Wall Street being on board with it, believe it or not. So this is, again, at some point, what tends to happen is as this rally continues to go, more and more of these hedge funds and large speculators, they can only fight it for so long before they have to start jumping in. So that's just more money that could come back into the market. And so another way to think about this is even just looking at the Wall Street forecasts. Yahoo Finance pointed this out a couple of weeks ago when we kind of look at where all these big banks had their kind of estimates for the year-end price target for the S&P 500. Everybody at the beginning of the year saying, where do we think the S&P is going this year? Obviously, as we got into, peak tariff scare, everybody, brought their estimates down tremendously. And they've bounced back a little bit. They've kind of brought them back a little bit, but not where they were. So what we kind of see when we see this chart is that Wall Street overall is still probably a little too negative, if you will. So some of the reasons we think that, we're not terribly concerned about, problems around the corner is, this is another one that we've talked about in the past, and you'll continue to probably hear us talk about in the future, is the high yield bond spreads. And so what this really is how much additional interest is the bond market as a whole requiring to lend money to a risky company relative to a U.S. Treasury, which is looked at as a very, very safe asset. And so in this regard, what you see here is that during the tariff scare, if you will, you definitely saw the spread rising quite a bit. I think we got up a little over 4% there for just a minute, it felt like, before coming back down. But we're not too far from essentially 20-year lows on interest spreads for high yield bonds. And so what that really says is the bond market is telling us it doesn't see a lot of risk out there in terms of companies being willing to repay their debt. Another way to look at this would be bankruptcy filings by year. Arbor Research put out this note showing that if you looked at the first half of the year, January 1 through June 30th, going back to 2010, the number of filings, bankruptcy filings by year, how many do you see? Well, the first half of this year was the lowest number on the chart. So going back to 2010, we have not had this few of bankruptcy filings in the first 6 months of the year. So another positive sign in our eyes that there's not a lot of negative aspects of this economy affecting companies at this point. The Atlanta Fed also puts out this GDP Now forecast every quarter. It's basically them soaking in all the data that's coming out in the economy and trying to forecast where GDP growth is going to come in. And so this particular chart is for the second quarter GDP numbers, which we haven't heard yet. They should be out shortly, but you can kind of see the green line here is that Atlanta Fed estimate, and it has come down a little bit lately, but it's still solidly in the 2.5% range for the second quarter GDP growth. The blue line is really showing where does kind of Wall Street see it being. And so in general, you would say Wall Street on average is still only around 2%. And so they kind of continue to be maybe a little too pessimistic on where things could come in. Kind of the shaded area is the range of the top 10 and bottom 10 forecasts out there to kind of give you an idea what the range is for the Wall Street estimates. And so most of them continue to be below where the Atlanta Fed is forecasting GDP growth. Another thing that we follow, there's a lot of talk. In fact, lately there's been a whole bunch of talk around this, but should the Fed lower rates, raise rates, stay where they are? What should the Fed be doing here? And there's definitely been a lot of pressure on Chairman Powell to lower rates from the administration and whatnot. But when we kind of think about this as should they or shouldn't they, one thing that we see is that there definitely is the ability based on their own notes. So when we talk about the beige book, this is kind of like the notes from the Fed's own meeting when they all get together and try and decide what should we do. What you've seen is the data of the transcript would kind of show you that the mentions of the word slow, so this would probably be like economic slowdown, for example, have risen to levels that kind of mirror or get back to last October, whereas mentions of inflation have actually dropped down to 2021 type levels. And so to some extent, the Fed has said they're worried about inflation and that's why they're keeping rates higher, but their own notes don't really show that. It actually shows them talking about inflation internally less and less. The same thing has happened. We're kind of early into earnings season at the time of recording this, but when we look at the transcripts of all of the S&P 500 companies' earnings calls where they're reporting their quarterly earnings, they're kind of then talking to shareholders. The mentions of inflation are back to early 2021 levels. And so companies aren't really mentioning inflation a whole lot on these earnings calls, which I think is a good thing. Another thing could just be, where should the Fed be? Historically, I think there's some good precedent for this. It's probably not a perfect way of thinking of this, but the 2-year Treasury in green here often leads or tells us where the Fed should be or where the Fed's going. And the 2-year Treasury, as of recording here, is down closer to 3.8% relative to the 4.33% on the effective Fed funds rate. And so there probably is a cut that could happen here, and the market would almost be expecting that at this point. The other thing we want to kind of jump to from an optimistic standpoint is, as you've heard us talk about this, we are huge on the AI theme, the tech boom that's going on out there in the country. There's a group of companies that we often refer to as the hyperscalers, and really what they are, they're these big tech companies, your Microsofts, Metas, Alphabet or Google, Amazons of the world, that are building all these data centers. And there's a few more of them that often get lumped into this as well. But if we're just focused on these big four right now, in darkest blue is 2025, you can see how much money each one of these companies is spending on building out data infrastructure. So CapEx is basically capital expenditures, or how much money is, say, Microsoft spending this year alone. It's almost $100 billion. I think Alphabet or Google just reported earnings and basically upped their, I think what they were planning on spending, something like 85 billion. They've even said we're probably going to spend a little more. I mean, collectively, this comes to a little over $300 billion just from these four companies into the economy. So these are massive, massive dollar amounts. And we don't see that slowing down anytime soon. If we think about what companies are getting out of this, and we kind of look in the past, you look at some of these past trends going back here in the last 40 years or so, from when PCs came in to an internet browser to mobile data, cloud services, et cetera, you can kind of get a feel for revenue per worker, so kind of a productivity type number for companies. This all bleeds through into margins, if you will. How much money, is the company making in profits relative to their revenue? And so with big data and this AI automation, we are absolutely seeing a massive uptick again here recently. Over the last handful of years for companies kind of coming from this technology boom currently. So we definitely continue to see companies spending in this area because they're definitely finding many, many uses here for artificial intelligence and whatnot. So that leads us to kind of another reason, this is probably a little small here, but that we are optimistic right now, is we did just have, and none of these comments, I'll definitely say reflect anything political. We don't care about a lot of that stuff. We're just trying to say, based on this new 1,000-page bill, what do we think the investment implications are? So, anytime the government puts through 1,000-page bills, there's going to be implications as it relates to our investments. And so a couple of things that we saw in here relate to individuals, that a lot of you might be interested in. There was something in here for auto loan interest being deductible for the next handful of years on cars assembled here in the U.S. We increased the SALT tax deduction substantially. So for people living in higher tax states, especially, that's something that will get noticed. All of these kind of individual items probably add up to something close to $80 billion in most a year. And most of this will come probably in the February, March, April time period of next year, because what we tend to see is a lot of these deduction type things hit and come back to us at tax time. So we all go file our taxes. The standard deduction went up for people 65 and older. We saw kind of an extra 6,000, I believe it was, get added to what deduction they can take. You've heard people talk about Social Security not being taxed anymore. That's not really true. Nothing was really changed with Social Security being taxable, but what they did do was for people 65 and older, they gave an extra $6,000, I believe it was, deduction to those folks. So it was kind of like, in a net basis, they're kind of able to say people on Social Security got a big tax break. But really, even if you're the 68-year-old who hasn't hit Social Security yet, you haven't flipped the switch, so to speak, to start those payments, you're still eligible for that additional tax credit as long as you meet the income requirements and such. But anyway, altogether, this stuff could lead to 80, maybe even $100 billion flowing back to the economy in the first, second quarter of next year when people file their taxes. And so even if we hit a little bit of a slowdown in the economy between now and then, that's going to be a pretty big shot in the arm that comes in to individuals at that time. And then from a corporate standpoint, there's some very big components of this that we think are actually pretty beneficial. And that is companies, when we think about those hyperscalers spending that $300 and some odd billion this year, not to mention any other factories being built or any kind of other big projects going on outside of those four companies, they put something in there where these companies will be able to expense the entire cost up front from these. Oftentimes when these big projects are done, you do see an amortization schedule that's something like 30 years. So over 30 years, they get to slowly kind of expense this big capital outlay or this big, big projects cost, if you will. Well, they're going to let them do this in 1 year all up front. I mean, that's a significant benefit up front for these companies to go ahead and start building factories, start doing more research and development, start building data centers, all of these things that end up being, very big projects. I think there's a chance we see a really big boom, especially for the industrial space, and tech space, and probably even the pharmaceutical spaces coming through with this tax bill from a corporate standpoint. So definitely a lot of stuff there that can definitely be looked at as a positive for the markets. There's definitely some negative aspects to it. You heard about some of the changes to the food stamp programs or to Medicaid, some of those, but a lot of those changes don't go into effect for a handful of years. So I think to some extent, if you kind of said the positive aspects are all going to hit pretty much immediately, some of the negative aspects are more down the road. We think that all in all, from estimates we've heard, there's probably a good 1% increase to GDP that could come from this bill alone in the short run. So with that said, we will probably end with some of those thoughts. We are still pretty optimistic. Who knows what the future holds? But when we do look at kind of some past trends and some things going on, it does lead us to believe that there is some pretty good momentum out there in the market. And we will kind of leave you with that. And feel free to reach out if you have any questions at all. And until next time, everybody enjoy the rest of your summer.